All right, so I want to take you into a trade that I took recently just when I got back. This was probably the only trade I've taken since I've been back. And I just wanted to show you how I've applied all these principles and just showing you how it's all just very much aligned with the process. All right, so let me just recap that. So my strategy is made up of just identifying tokens that have made big movements in the markets. So what I'm always looking for a token that's done 20, 30, 40, 50, 60, 100% that day. And then I know whenever a token makes a big run, so I'm basically catching it within its expansive move. Once a token has made an expansive run, it's going to hit a relevant level at some point and it's going to make a retracement. It's just how the market works. So my whole strategy is around identifying tokens that have made big movements or in a big movement, and then I mark out the next most relevant key level that it could reach, and then I'm anticipating there's going to be a reversal or at least a big retracement from that point. And this is my whole strategy, is I'm always just waiting for a big move. I don't usually trade like continuation entries like you might in this example. These would have all been continuation entries. We might have turned on, we might have seen here, like if we go into a higher time frame, you'll see over here, we would have identified that this chart was showing, continuation to the upside. There was big bullish movements. So if you come onto a lower time frame, there would have been lots of opportunities to catch continuation entries. You can see we could have caught a continuation entry at the break of that opposing level or at the break of that opposing level as well. But I don't usually trade this way. I like to wait for price to come to a key level. So what I'll do is I'll zoom out onto like a daily chart, even a 3-day chart, sometimes even a weekly chart, and I'm looking for key levels. In this example over here, the only key level that was really relevant to me was I could see this fair value gap. And now keep in mind, fair value gaps, even though they've been used, as in this example, they can still continue to become relevant. I've seen fair value gaps become relevant over large portions of time. So I marked out this fair value gap. This was a relevant point. And then I also marked out this candle over here as a relevant point. So I knew somewhere around here, I was looking for a retracement to occur. The usual place I like to look for is if price is rejecting the 50% level of the fair value gap. So all I did is I zoomed out. The next place I would have looked, would have been this high points, this candle high as well as this candle high. So this is my thinking was, I was just going to go mark out whichever relevant areas I could or key levels I could on the higher time frame to observe that these could be the possible areas price could get to and cause a retracement. You can see over here, this was a previous swing high. And as price hit that swing high, we got a nice retracement that occurred. So oftentimes it will happen this way. But basically, this was the area I was looking to zoom in on. So I came down into a lower time frame. And also something you want to keep in mind is that if price is moving with quite a lot of velocity, if price is moving with quite a lot of momentum, you often need to go onto a lower time frame to catch it. So for instance, this coin had moved, it had moved 41% in 12 hours. Oftentimes, and especially during this run, from this point on, we got these big expansive moves. So that was almost 30% in 3 hours. That's 10% per hour that it's moving. When you see a token that's moving with this kind of momentum, you have to actually go onto a much lower time frame to catch it. Because if you're on a token that's moving very slowly, it's okay to be on a higher time frame. But when something is moving very fast like this, you will miss the move if you're looking on a higher time frame. So for instance, when price came up to a potential place of reversal, when I was looking in this region, if I had waited on the 1 hour, I would have 100% missed the move because it's moving too fast. So you have to actually go onto a much lower time frame. So then what I did is I went onto the 5 minutes, 1 hour model. And this was the model I was looking for a retracement to occur. So I see price is coming into my entry zone. So you can see all we're doing now is we're waiting for price to come into our zone. Price has entered over here. It had gone past my 50% level of this fair value gap. and was entering into the wick of the other, this previous wick that I'd marked out. But basically, this was the region that I was looking for something to happen in. So sometimes we can never exactly pinpoint target exactly where the reversal can happen. Sometimes you might get it right, but we never really know, is it going to happen exactly at that point? It might, but sometimes it might not. So all I did was I waited for price to come into this relevant region, and then I just waited for a reversal to occur. And you can see this was pretty obvious actually. Price came, tapped into this level. We got a failure to displace. This wasn't such a big wick, but it showed this big candle. You can see as it took it out, we got this big drop to the downside. So did I know if this was going to hold? We never 100% can be, in the market. You can never know with 100% guarantee what is going to happen. But all I'm doing is I'm just following the rules. I'm following the steps that we teach in the course. So once price hit this level and retraced, this would have been a perfect place to look for a reversal. I could have also looked on a little bit of a lower time frame, which I would always do as well. Go into a lower time frame and get more confirmation over here, and you can see this sweep that was taken out. This sweep, you can see over here, we had a few different areas that did sweep. If I look on the lower time frame over here, you can see this high was swept by all of those. Swept that high because you can see this is what forms the wick. Price takes out the highs, but then drops below back into the range of this candle. And at that point, we know the wick is complete, and then the body is going to start. So I entered this trade when I saw this candle over here. This was a confirmation for me because it was quite a nice, I saw a bit of a bearish candle. Sorry about this. There we go. You can see this is the candle that took out the high, and then it had a bit of a bearish drop. But I actually entered this a little bit early. I was a little bit naughty, but sometimes you get an intuition for these things. If something is going to make a massive move like this, is going to be a drop that's going to happen. So price hit here, we had two different possibilities. You can see over here, this would have been a bearish CISD over there, or there was, if we went on to a little bit of a lower time frame, you could have gotten a very nice entry over here, which is what I entered on this region. You can see as price broke below with this candle that I marked out over here, this candle. As price broke below that CIC, this is the place to take an entry. And basically, this is how it looked. You enter on the CISD, stop loss goes above the highest high point or the manipulation point, and then we can target the lows. I targeted, whenever I set targets, so say for instance, you can see this is the higher time frame model. I like to look for the previous candle lows. So you can see if this was a true reversal, a really great target can be the previous low candle. If you're looking on the 1 hour, see this is the 1 hour candle. If you were looking on a 30-minute candle, for instance, the next relevant low would have been over here, which would have been a fantastic place to have a target, or you could have had a second target at the second low. So the way SMCX is currently structured is it marks out the previous two low candles after the displacement occurs, just like this. So if this was the displacement, would have marked out this low and this low as relevant take profit regions. And also you can use the fair value gaps. So you can see we had a fair value gap over here, which would have been a place to take a target, or this would have been a fair value gap as well. And you can always use the 50% of the fair value gap as targets. So when it comes to targets, there's lots of different ways you can use it. I like to look for the lows or the fair value gaps. Those are very good places. For this example, this was my entry, and then you can see price just displaced. This would have also been a second place to look for an entry, because now that we got this displacement, so you can see this is where you can start to really understand what is happening with this asset, because we got the break of the first CISD, and then we got a break of the second CISD over here. But this was a very big break. You can see this displacement to the downside is showing us now that this could be the precise place where the market is going to turn now from this bullish run to this bearish run. Because if you look at the opposing run, look over here, we're getting displacement to the upside, displacement to the upside. And now finally, this is the only place we start seeing displacement to the downside. So once we start seeing our first fair value gap developing through nice set of displacement to the downside, this can show us that this in fact has shown a true reversal from this bullish run turning into a bearish run now. So if we look for re-entries, you can see if price broke below the CISD and say we didn't enter over there, we can look for retracement into the fair value gap, which oftentimes will happen. Price will break below, come back into the fair value gap, then drop. It didn't happen in this example. You can see price just seemed to drop. Let's see, did it actually retrace back to the fair value gap? I don't think it did. It just dropped and dropped and dropped. Let's see if it take out our targets over there. I actually ended up taking my profits a bit sooner over here because you never know how far it's going to go. And sometimes I recommend, if you get 3, 4, 5, even 10%, take most of it off the table. I took majority of my profits and I just let the rest run to see how far it would go. But that's also a strategy that's important. If you see money on the table, sometimes it's very good to take, because even though this was showing everything that looked right, this still could have turned against us. I've seen it happen multiple times. All we can do is we can stack confidences in our favor and probabilities in our favor, and then just hope that there's no randomness that will happen. Oftentimes there can be randomness that can go completely against your strategy. You can do everything perfectly. You can follow the strategy, you can follow the rules absolutely perfectly, and then some randomness that will happen that will go against your strategy and go against your rules. It does happen. So it's important to know that if that does happen and you followed the rules correctly, that you still did things perfectly. So let's see what happened there. And you can see we got a little bit of a retracement back up. And then I think price, did it come take out those lows? Just waiting for it to take out these lows. I don't know if it does actually, or eventually it does. So you can see these were the lows that were marked out, and look how much you would have had to endure before it took out the lows. So sometimes it's not as straightforward as we like. Sometimes it doesn't just hit our lows like we want. But you can see over here, price came into this fair value gap, and then we kind of got a reaction, and then it came back down, and then we got a move off of that. So we also pay attention to opposing fair value gaps, because we can often get reactions off there. But this took a while. I mean, if you entered the trade over here and you were holding, it would have taken you 6 hours of that trade for it to actually take out these lows. Let's see, does it eventually take out the rest of the lows? And there you go, it finally takes out all those lows. So this would have been a long trade to hold, and it does take a lot of patience. You would have had to wait 7 hours for it to take out the full lows of that trade, or you could have just exited the trade, let's just say over here, 45 minutes for 12%. So if you'd exited here for 12%, it would have been 45 minutes. Or if you'd held it to tap those lows, it would have been 7 hours for an extra percent. So sometimes you've got to weigh out how long you want to hold a position for. And through all of this time, you never know, it can turn against you. The market, can get back here, and then all of a sudden it can get more energy and it can suddenly start taking off again. But anyways, I wanted to break down this trade in as much detail and give you as much of my thinking as I could through this process. But basically, once you've set your stop loss over here, like I did, I entered at this point, set my stop loss above there. Then if price drops lower down, all you can do now is you can move your stop loss down to your entry point, especially if it's broken the second CISD or the second opposing, then you can set your stop loss above the first one. But once you see this big displacement to the downside, this can give you a lot of relief, because once we get bearish displacement happening after a concession of bullish displacement, it can show this true reversal has in fact taken place, and that you will still see more downside. What you can also do is over here, we can start to look at our higher time frame candles. So you can see, if we look at this higher time frame candle over here, what do we notice? We notice it's got a small wick. Can you see? Very small wick on this bearish candle. So this is letting us know this is a high probability of being an expansion candle. And what was it? It was an expansion candle. So these are little signs, give us a little bit more clues. If this had been a bigger wick, there's less chance it was going to be an expansion candle. So you can see price broke down. If I turn on the opening candle, which we spoke about over here, you can see this was the open of this candle. Let me remove some of these things so you can have a better look. So you can see we got an open, high, low, close. So you can see price opened over here, then expanded high, and then got below the opening points. And at the same time, it broke below the CISD level. So this is exactly how we're showing you how you can use opening lines with CISD combinations and your ability to determine whether it's an expansion candle. And then you just tie all of these confluences together, and you have a high probability of success.